Hi, welcome back. The big macro headline is the fact that Madhya Pradesh has taken the lead in writing off farm loans up to 2 lakh rupees each, and Chhattisgarh too has announced a similar intent. To find out what the macro impact of this could be, Devendra Pant, the Chief Economist of India Ratings, and Soumya Kanti Ghosh, the Group Chief Economic Advisor at State Bank of India, join in. Gentlemen, morning to both of you. Devendra, I want to start with you. I know in the very near term, everyone talks about a positive, etc. But over the long term, the diminution of credit culture and the moral hazard that this act would spawn, don't you think that it would lead to a rise in NPAs, at least the agri NPAs in the banks?
Yeah, you're right. There will be both favorable and adverse impact. As you rightly said, favorable impact can give some push to the demand. However, you rightly said the bad credit culture. The more important is, look, when we look at state finances or country's finances, deficit per se is not bad, but the quality of deficit, the purpose for which this is incurred. Now, what is going to happen is we will have more deficit coming because of the current consumption. We will be financing the current expenditure, but not the capital expenditure. Now, what is going to happen is, as of now, there is no number. We are looking at somewhere around, maybe around 40,000-50,000 crore worth of farm debt waiver, and that is going to have a straight impact on the capital expenditure, which is being incurred by the states. So, it will put economy on a path where we are not investing sufficiently in the future revenue generating or growth generating assets.
Yeah, got that, Devendra. Let me get Soumya also in on that. We were told that MP's fiscal deficit, Madhya Pradesh, is 26,780, which is 3.2% of gross state domestic product. This is, of course, the 14 Finance Commission's limit was 3%. Likewise, MP's debt to GSDP ratio is 27%. The Commission's stipulation was 25%. Now, Soumya, what does this mean? We hear Chhattisgarh. In fact, there is competitive farm loan waiver in the air. Do you think we are going to see a spate of state reneging on their limits?
Yes, I think Madhya Pradesh, I think the amount could be around 35,000 crore, if I am not correct. So that will actually take the amount till 2008, when the farm loan waiver has been announced by the central government, to around close to 3 lakh crores. So the problem is that, given the Finance Commission conditions of incremental debt as a percentage of GDP and fiscal deficit as a percentage of GDP, those two conditions, I think these states will not be able to borrow from the market. So if they're not able to borrow from the market, obviously there will be some way of trying to balance the revenue expenditure math, and the obvious problem in this case will be expenditure compression. So that's point number one. The point number two is that this debt waiver actually leads to a situation whereby you will find if no other solution is found is given out to address the problem of rural distress, I think in 2 to 3 years you will again find this loan waiver coming as a solution. Because this actually leads to an increase in the NPA, vicious the credit culture, because until and unless that account is not cleared of NPA, they will not get fresh loans. So agricultural credit also starts to decline. So there are a lot of negatives regarding the loan waiver, and I think that at some point of time, if there is no agreement on this loan waiver, this is going to hurt the fiscal position, obviously will be hurt, and also the other macro balances.
So you spoke about expenditure compression, which is one issue, and of course agri credit that may get impacted. Before I go to Devendra, Soumya also wanted one follow-up on that. In your assessment, states that have gone for waivers in the past, have they seen the agri capital formation? Because now what this does, it takes the focus away from capital formation, right? So have these states in the past seen agri capital formation as a percentage of GDP fall over time?
Yes, they have seen it fall over time, and if I give an example, actually there are states which are now announcing loan waiver. Chhattisgarh, for example, in 2015 had announced a small loan waiver. The same state is announcing a loan waiver again 3 years down the line, and the states which are announcing the loan waiver, if you actually look into their indebtedness position, you will find that the formal sector credit in these states are actually on the lower side.
Oh.
So that's actually the problem, and until and unless that problem is not solved, your formal and informal sector credit distribution, I think this problem is unlikely to be addressed.
Devendra, are we heading to a rating danger at all? Will rating agencies look askance?
Look, I leave it that for my sovereign colleagues to decide. But yes,
No, I'm not asking if India ratings will downgrade India. I'm asking you generally what is the what will be the view, because the central deficit has not really been violated as yet, but the finances are already in trouble. The GST collections have not been as anticipated.
Yeah.
And, you have the states also kind of moving above their set limits. Therefore, is there a danger to rating?
Yeah, look, there are pressures. So what we are looking at last 3-4 years when the rating agencies look at it, they look at everything put together. So general government deficit, so center, state, everything. Then what kind of contingent liabilities? Unfortunately, those things are almost at the same level. Almost at there, maybe 10-50 basis point here or there, almost flat in last few years. So that is one major factor, the overall indebtedness position of the country, so that to GDP and all those. There is not much change. Okay. But here I'll just add in one point. See, general it is the 3%, but what happens is Finance Commission allows two options where you can go even up to 3.5% of the GST.
Okay.
So what happens? You should have a revenue surplus. Then the previous year your interest payment should be less than 10% of the receipts. So you get another 25 bips. So that's why MP will qualify for that. So 3.25. Okay. Then the debt to GSDP should be less than 25%, where it is not qualified.
Which is not qualified.
Yeah. So in that condition, one can move even up to 3.5% of the GST.
Okay.
It is going to happen something similar to what center is doing, borrowing from NSSF or borrowing from here and there, so that the market borrowings
got that. Soumya, what's the impact on markets? Should they worry because yields have been only going down. You can renege on fiscal deficit anywhere, but yields are not bothered at this point in time.
No, see, I think the markets have largely factored in spate of loan waivers, and now I can see that the oil prices are actually declining even further. So there has been going to be rallying in the oil market, and the macro conditions, I think, are right now, for example, the real sector variables like the IIP and other things are not going to be that significantly higher. So I think yields will stay under control because yields are also a true reflection on the real sector fundamentals.
Okay. Just before we let you go, Soumya, if farm prosperity is the objective, and we assume that is, what do you think the sustainable, solutions could be? I mean, a lot of people have spoken about, say, reducing post-harvest losses, better market pricing, more financial inclusion, etc. What do you think the more feasible options could be?
No, these are all very good solutions, but these are all actually long-term solutions. I think immediately what could be the best solution under the current circumstances is to provide some sort of an income support to the farmers. So I think, and there are various options of it. That could be an examination of the income support, and the cost of that income support could actually also be on the lower side, also on the higher side. Okay. So that has to be seriously considered now, because until and unless there is a structural reforms can actually happen over a period of couple of years, but the short-term reforms of these are more important at this point of time.
All right, let's see whether there will be any reform in the way in which money is reached to farmers. Thank you very much, Devendra Pant and Soumya Kanti Ghosh. Well, for the market, the key takeaway is this is factored in, and yields will anyway move lower because crude prices are moving lower. So at the moment, maybe we can relax and actually see it as a positive, as a near-term positive. Although it's a big long-term negative, the near-term positive is there's more money to spend.
Okay, and a big long-term negative, don't forget that. But let's get some more views in on the F&O space now. Chandan Taparia of Motilal Oswal Securities is joining us. Hi Chandan, good morning. It's been a ferocious rally we've seen on the index. You get a sense that could continue, and what would your own stock ideas be today?
Yes, first talking about the Nifty, market is continuously forming the higher lows from last 4-5 trading session. It has seen the strong rally of more than 550-600 points from its recent low of 10,333 zone. We have seen a sharp cut in India VIX as volatility index has corrected by around 30-35% from higher of 21.5 to below 15 levels. So volatility is cooling down with jump in the put call ratio. We have seen surge in the put call ratio in last 5-6 trading session from 1.30 to 1.65 kind of level. So rising put call ratio with declining volatility indicates that overall bullish setup of the market, and now till it holds about 10,800 zone, momentum could extend towards 11,000 and plus kind of level. We have seen fresh put writing at 10,800, 10,700 strike, which also indicates that decline could be bought and supports are intact in the market at the lower zone. So I think stock specific action could continue, and buy on decline with positive bias could be the strategy for the market. Similarly, the Bank Nifty has surpassed 27,000 and the supports are gradually shifting higher. Till it holds about 26,666, we are expecting the rally to extend to us 27,250 to 27,500 in the Bank Nifty index. Now talking about the stock specific idea, first that is buy on HDFC Bank. This stock has seen the strong momentum in last 2 trading sessions. It has seen the recovery from the lower levels and overall trend of the counter is positive. It has managed to recover and holding near to its previous series high level. We have seen intact put writing, and the stock is surpassing its falling supply trend line on the daily and the weekly scale. And if market has to move up and Bank Nifty has to move up, then HDFC Bank has to take the lead, and that's why we are expecting the positive momentum as per the price setup of the counter. So one can buy with a stop loss of 2103 to play the upside move towards 2180 to 2200 zone in the counter. Second trade is buy on NIT Tech. This stock has surpassed its falling supply trend line and surpassing its 50-day exponential moving average. So positive price action could be seen towards 1212. One can buy with a stop loss of 1133 level. One more trade that is on option strategy front, that is buy on BPCL. The stock has given a breakout from its small pollen flake, surpasses consolidation zone, holding the built up of long position by around 8 to 9% on last trading session. So this stock has potential to move to a 362.65. One can trade with bull call spread by buying one lot of 350, selling one lot of 360. So entire risk is around 3.5 and reward is 6.5. So almost 1:2 risk reward ratio, and expecting BPCL to move on upside to a 362 kind of level.
All right, thank you very much. You're the third expert in the last 10 minutes to be bullish on HDFC Bank. Thank you very much, Chandan. Well, with that, let's invite Prakash Diwan, our expert for the morning. Good morning, Prakash. Well, the market's run up a lot. Generally, are you getting a sense that it is run ahead of itself, or do you think that there is a turn in fundamentals?
No, I think the run-up in the market, Lata, is more in anticipation of a turnaround in fundamentals. We've not seen that happen. Yeah. The only thing that's changed between today and 10th, which was last Tuesday or Monday, whatever, is that the mood...
Is that the ruling party lost an election and...
The mood is very expectant in terms of, change happening finally. This change in the air, that's all I can say. And that's probably built a little bit of hope. The way to play this market is, if I were to go only by the premise of any change in fundamentals, I would probably still sit out of the rally. But the momentum is too mouth-wateringly attractive to kind of be out, for traders particularly. For long-term investors, the opportunity has always been there, even earlier, and will continue to come up, maybe if not around another 15-20 days later. So yes, we are in for a Santa rally, and I can see Christmas happening a bit earlier than 25th itself. And what's likely to move, like I remember you discussing this loan waiver, the impact and all. So while, the other side of the coin is damage to your your balance sheet as a whole, as a nation.
Yeah, a moral hazard.
Yeah, it's about, but we have anticipated these fears, and then things turn out very differently when the long term happens. So there could be different things, but here the consumption theme is come center stage all of a sudden. And yesterday I was quite surprised. One of the key players in the capital goods segment is Thermax, and the management was talking about things which are picking up from the capex side. So when the private sector capex is what starts joining the public sector government spend, then things are very different. And I think there's some semblance of that happening also. So let's look forward to the justification of these PE multiples at some stage.
Okay, since you're talking about, this whole private sector capex or even orders picking up, I don't know if you heard the conversation we had with IRCON a while back. 15 to 20% growth is what they're expecting in earnings. 27,000 crore order book. Yes. This is space you've tracked closely, railways. You like it?
So out of this, actually, I end up always going back to rights as the better alternative. You know, I've looked at Ircon, I've looked at REITs, and sometime back I remember REITs on our channel was talking about, you know, CAGR for the next few years, which was 32%. And now they've come up with a dividend announcement, which is fairly decent, okay? And as a matter of disclosure, I also own the stock. It's got a recent history, so it's not come on the radar for a lot of technical charters, for a lot of traders yet. But as a fundamental business model, it's very uniquely placed. So on dips, you would have to just buy into these kind of things and not necessarily, you know, worry about how it's going to do next week. But this is genuine long-term bets that you are taking.
Okay. What would you buy now that the market, as you say, there is a mouth-watering momentum? We did see, of course, an outsized fall in small and mid caps. Is there anything that comes to the mind as now attractively priced?
The first wave of this momentum will probably be predicated on the moves of the large caps, is my sense. You know,
that has been the
and more so the reason being there has been a little bit of underperformance, you know, under participation of the likes of Reliance Industries, the HDFC Twins, L&T, you know, so. And if the Nifty, if I were to look at, you know, just a very strong, stark Nifty change, move in the Nifty, I mean, these heavyweights could do dramatic, you know, it could have a very dramatic positive impact on the Nifty's move itself for the next 15, 20 days, 30 days. So I think that's where things will look up. I don't see any reason why Reliance will post weak numbers. We are now kind of, you know, it's December end. Another 20, 25 days and we'll be talking about results. You know, we'll begin to talk about results. I don't see any reason why, you know, we would kind of let a giant like Reliance be sleeping at these levels when results are around the corner. Things could look up. IT could, you know, make a comeback with the heavyweights like TCS and Infosys and all of them. Okay. So, point is that stick to the heavyweights right now for at least the first wave. You know, the mid caps and all the quality mid caps like VIP and all of these, some of these financial services businesses have made a comeback. I have seen 20% in the last 1 week. It's like, you know, difficult to digest saying what's the change, but then.
Okay.
That's
you know, I want to ask you, I know you want to stick to large caps, but I also want to ask you about Ashoka Buildcon. But I'll do that after a small break on the back of that City Gas distribution JV. So we'll take a short break, come back with the pre-opening rates.